I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Benchmark Income Group.
Welcome to the Big Wealth Podcast. Today, we are going to be talking about everyone's favorite topic, life insurance. We think this is a really important topic because there are a lot of preconceived notions about life insurance. And specifically today, we're going to talk about permanent life insurance. So we're going to be talking about some things that come up fairly frequently on this topic. I think over the course of our career, we have compiled a list of reasons that people don't like life insurance or things that people believe about life insurance that may or may not be true. And we're just going to go through them here. We're going to do a 3-part series on this because there are a lot of preconceived notions about life insurance. And we're just going to go through bit by bit and see where the conversation takes us.
Yeah. So there's I'm trying to think how many's on this first one. There's 8 or 9 of these. So we're gonna go fast and furious. But this should be pretty fun. So I'll kick them off and then we can chat about each one. So one of the ones that I use quite often actually, and one of the myths about permanent insurance is a phrase of life insurance should not be rented. There's really 2 kinds of insurance. There's term and permanent, or term and whole life. And so a lot of the conversation around that is term insurance is a little bit like renting. So Mary, talk a little bit about why insurance shouldn't be rented as a myth.
So I actually think sometimes it should be rented. And again, we're going to get away from some of the opinion side of this and start talking about the facts, because when you have the facts, you will know what to do.
Right.
When I think about term insurance, the reason that term insurance does make sense is that you can get a lot of death benefit for very small amounts of cash flow.
Yep.
So especially when your goal is to make sure if something happens to you, that your income, there's enough money that shows up that it replaces your income for the remainder of your working lifetime for your family. About the only way you can get that much coverage without it just taking up your entire budget is by purchasing term insurance.
Right.
So I'll speak personally. About half of my insurance, 40% roughly of my insurance is term insurance.
Yep.
The other portion of my insurance is whole life insurance, which is permanent and will last for your whole life. It's different than universal life or other flavors. But the reason that I have a combination, when I was young, about the only thing I could afford was the term insurance. Although I did have a whole life policy when I turned 21. It was just a very, very, very small one. And then having that in place has enabled me to do several different things. That term insurance not only serves to protect my family, there's a big lump sum that shows up if I die, and then that can be invested to throw off income for my family. But it also protects my health rating. And so if I decide later that I'd like more permanent insurance, I have the ability to get that without going back through medical underwriting. And even if my health has deteriorated or I become uninsurable, because I already had the coverage through convertible term, I have the ability to turn that into permanent insurance later if I want to. So I think when you hear someone say that your insurance should not be rented, there's definitely an argument that some of it should be, because it's the only way you can get enough death benefit in place that if your goal is full income replacement in the event that you're not there, you have the ability to do it. And for me, that's incredibly important, because I think if something happens to Mike or if something happens to me, life is already going to be hard enough. I don't want our financial situation to deteriorate, because you're already going to be dealing with enough emotional havoc in that particular situation.
Right. Well, and that actually leads to the next one that we hear a lot is, and that I've said a lot, and you just said as well, and I'll talk about this one, but you should buy insurance to preserve insurability. And this is exactly what Mary just talked about. This idea that, we rent a lot of coverage over time, right? I rent my car insurance. If I don't get in a car accident this year, the insurance company does not write me a check for that. And so there's a lot of insurance that gets rented. But one of the cool things about term, especially with term, is we don't get better with age, right? There's things that happen all the time.
I think my personality does. My personality is like a fine wine. It does get better with age. My health might not.
Yeah, the only thing about my personality that changes is it just gets more salty. So I'm not sure if that's
It
usable, but
gets saltier with age. I like it.
yeah, that idea that I want to rent the house. I want to rent the house and be able to buy rooms at a time, but I want to not be able to. I want to not be kicked out of the house when it's time for me to rent and move from renting to buying that next room. And that's one of the key pieces of that term component is future proofing your plan and being able to know that no matter what happens health wise, you have the ability to execute everything that you'd planned for at the very beginning, which I think is really cool.
But I think it's interesting that anyone would say that you shouldn't use a term insurance policy to preserve your insurability. So for those of you that are not familiar with how this works, when you buy a term insurance policy, there are different types of term insurance. Some term insurance is convertible. And what that actually means is that just by filling out paperwork, you can take that term insurance and turn it into permanent insurance at the same company.
Right. At
And
the same
so
rating.
at the same health rating that you had maybe 10 years prior, and in some cases, even 20 years prior. And so it guarantees your ability to take coverage that is being rented and turn it into permanent coverage. The idea that someone would say you shouldn't do that is interesting to me. It's not cheap to do something like that. But we spend a lot of time, and there are previous podcasts where we talk about the importance of introducing permanent insurance to an overall financial plan, not
Right.
for the death benefit, but actually to optimize your income strategies when you're ready to take income. And so
Right.
if we know that we may need more permanent coverage to keep our investments and on our insurance components in balance, why would we not want to preserve the ability to do that, regardless of what happens with health? I think one of the key roles that a financial advisor should play in somebody's finances is making sure that the plan is not based on hope. The plan has to work no
Right.
matter what happens in your life. And so if you're hoping that 15 years from now, your health is still going to be good and the coverage will be affordable, that's not a great strategy because you have no ability to control for that variable.
Yeah. And there's actually a couple of situations that we've played with and we've actually implemented before where we've gotten whole life, convertible term, and the term that doesn't convert, that you're just looking for coverage. And there's a place in plans for all three. And one of them I'm thinking of is we had a business owner. There was an issue where, hey, if he runs out of birthdays or if she runs out of birthdays before they retire, she needs to make sure that they have a what's called a buy sell, that they're going to buy out the partner, buy out the spouse of the partner. Well, there was no plan for that coverage to go do more. We already had that taken care of. So that term we wanted as dirt cheap as we could get it. It was doing one job and we needed it to just solve that one problem. And so that it's this idea of having a more nuanced approach to how you build out your coverage and your policies. And so it's neat to have them sort of segmented out in that way. And so I think that nuanced approach is a much better way to go look at it.
Well,
All right. So let's,
but I just want to add this in. The
yeah.
types of things that would make you uninsurable could be, you have developed a problem or a health issue that is going to be with you for the rest of your life. So it could be a chronic health issue. So it could be that you've discovered that you have some type of condition that didn't show up before in your medical records. And that particular condition would make you uninsurable. It could be something like if someone develops cancer. Even when you beat cancer, the insurance companies are going to look at what stage did it get to, what was the treatment,
Right.
what type of cancer was it, and they're going to assess the risk. And a lot of times, if you have any type of cancer show up in your medical records, you become uninsurable for anywhere from 5 to 10 years, meaning no insurance company is going to write a new insurance policy on you until you've been in remission for a 5 to 10 year time period. And frequently, if there is a recurrence of cancer during that time period, that makes you uninsurable for the rest of your life. And so it is really important to make sure that if you want to leave a legacy to your kids, or if you are looking at how permanent life insurance can increase what you can spend in retirement, you want to guarantee your ability to have that coverage no matter what happens in your life.
Right. Well, and that takes us right into that second question that we were looking at And I'll see if I can pull it up because I keep losing the screen. And Mary just talked about this. So one of the myths that we hear sort of as a denigration against whole life is it's great for pre-retirement income protection and a great way for permanent death benefit. And I think a lot of the sort of detractors from whole life are you can outrun any problem with a better mutual fund, or you can outrun any problem with market rates of return. You don't need some of these other things to go help supplement your income at retirement, or you don't need some of these other components. Your only solution, the only problem you have, can all be solved by a better market or better real estate or better investment selection. So
Right.
let's talk a little bit about whole life is great for pre-retirement income protection and a great permanent death benefit.
Yeah, I think that, this goes to exactly what you just said, right? There's a strategy out there called buy term insurance and invest the difference.
Yep.
And that is one of the more common strategies that is recommended in the US today. And so buying term and investing the difference could be the only way that you can invest and grow your money if your budget is really tight. But a combination of whole life insurance and investments creates different distribution strategies, different ways that you can take income. And so if we shift our focus away from, I just want this big pool of money, regardless of how much of it I can spend and enjoy each year, to I'm going to build more efficient income strategies, you can get to more income with less assets if you introduce distribution efficiency, right? And that happens when you have the right ratios of whole life insurance and investments. And there's some white papers out there that you can read on that.
Yep.
But the idea is that you can get to better income. Now, I think it's interesting because when you are only looking at net worth, you might be able, most likely be able to get to a point where you have higher assets. But as we've talked about in previous episodes, the safe withdrawal rate when you get to retirement is anywhere between 3 and 4%. And based on our research, we lean heavily towards the 3% is the safe withdrawal rate.
Right.
Especially over life potential, as opposed to just looking at life expectancy. And so if you want to take more income, there has to be the ability to buffer against market volatility. And that way you can take higher distributions from your assets, because in years where the market is down, you have the guaranteed cash value in a whole life policy that you can take your income from while your portfolio makes a full recovery. Because otherwise you're just going to end up, withdrawing more when your portfolio is down. So you're really compounding your losses and then crippling the ability for your portfolio to get whole again, because you're also withdrawing that recovery. But if you've got an alternate source of capital that is not fluctuating in value, even if it's growing more conservatively, what you've introduced is the ability to prolong the life of your asset, to preserve the principal. And the longer you can preserve the principal, the more income you can actually take. And so I absolutely 100% believe that you can take more income during your lifetime if you have the right combination of permanent insurance, whole life insurance, and invested assets. So the research shows that. The white papers that have come out by Dr. Wade Pfau have conclusively proven that. And Dr. Michael Finke
as well,
has been on some of those white papers, and he was a huge I hate life insurance guy until he did the research. And so I think sometimes we hear stuff and we're like, oh, on the surface, that sounds great. I can get a higher rate of return. But if we aren't paying attention to what the academics and the PhDs are doing in their research, and we're just listening to other people's opinions, we could be accidentally shooting ourselves in the foot when it comes to how much income we can enjoy during our lifetime. And I don't know about you, Eric, but if I have the ability to enjoy more income and leave a bigger legacy for my children, I'm 100% on board.
Yeah. Well, and it goes to these two things that I think are sort of religiously fighting against. One is trying to make sure that every client is asking the right question, right? So we are conditioned, programmed, and marketed to solve the problem of big pots of gold. Whoever has the biggest pot of gold wins. And the problem with that is once you shift over to thinking about maximizing income and not maximizing net worth, all of the solution sets change. If I'm just looking at pots of gold, maybe all market all the time or all real estate all the time is the way to go. The second half of that, though, is when I think through I'm not going to call it intellectual dishonesty, because I think the people that are doing it are well-intentioned. But when you think through this idea of diversity, and then you think through the solution for how to go retire, all the problems or all the solutions look like more market, different market,
right?
smarter ways to go do market. And there's no diversification in the assets that they bring into the party to go maximize income. And so
Right.
when you think through real diversification, real asset class diversification, it makes sense to have different asset classes doing different jobs at different times to get true diversity on some of those things.
Well, I want to look at this too from a slightly different perspective, because when I think about income protection, I think about it in two key time periods. One of the time periods is income protection while I'm the one earning, right? How do I protect my income through that time period? And then the second component of it is, how do I protect my income once I retire? Those are very different time periods, and you need different things. So if I'm thinking about, I just want to protect my income while I'm earning, I might lean into term insurance being the best solution, because I can get a whole lot of death benefit for a very, very small amount of cash flow.
Right.
So if I'm just looking at one little piece of my life, the part where I'm working, I guess that's not a little piece, it's a big piece. If the only thing I care about is protecting my income while I'm working, then I'm just going to buy as much term insurance as I can.
Right.
But if I care about protecting my income and making sure once I retire that I get to take more income, and that I'm either guaranteeing that it lasts for a lifetime by using certain tools that involve actuarial science, like an annuity, or creating that market shock absorber so that I can take higher withdrawals, then I do need the permanent life insurance piece in order to be able to do that. And so that goes back to the idea that it's not an either or decision. I don't have to pick all term insurance or all life insurance. Actually having a blend is what's going to help me, because there's a specific amount of permanent insurance that I need based on the assets that I'm growing. There's ratios there. It's very Goldilocks, too hot, too cold, just right. But when I think about income protection while I'm young and I'm working and cash flow might be tight, term insurance is definitely going to be beneficial there, because if I need to reproduce $90,000 a year of income, and I know I get to spend 3% of my portfolio, I got to have $3 million worth of death benefit. When I'm young, the least expensive cash flow way to acquire that is term insurance, but I can't neglect the permanent insurance part of the equation, because that's what protects my income during retirement. So when people say, if it's just about income protection, just get term insurance, they aren't looking at your entire lifetime. They're only looking at while you're working. But I'm going to make the argument that protecting the income once you retire is just as important for your family as it is in your working years.
Yeah, because in my working years, if I have a problem and I'm not dead, right? If I have a problem, I can always get another job or work harder. But if I'm 77 years old and I've got an income problem, some of my options may be limited in what I can go do, right? And so it's part of it, I think, is projecting ourselves out into the future and understand that physical and cognitive decline are a real thing, and we've got to take that into account.
Ageism in the workplace, also a real thing.
Sure. So let's talk about this next one, because it was a great lead in. Waiver of premium riders are a good way to protect your retirement income or your retirement from your disability. And one of the things that we talk about,
some people believe that's not true. Right. That's why we're talking about it.
Correct. And so one of the things you talked about was, hey, I got to protect my income while I'm working, so I have a lot of term insurance. Another great way to protect the biggest asset you have, which is you, is not just term insurance, and that only kicks in when you're dead, is also disability insurance, which kicks in if you're not working and not dead. Right. So that's one of the key pieces. But one of the neat riders that you can have on an insurance policy is what's called waiver of premium, which means if you become disabled, the insurance company steps in and starts writing checks to cover the premiums that are required for the insurance policy. And I think those are such huge protection vehicles that you can add into those policies, because if I'm disabled and not working, my income's probably not as big as it used to be.
Right.
But I want to make sure, and my expenses are up, right? I got hospital visits and everything else. But one of the things that I don't want to have happen is, if I get sick and I can't work, I don't want the whole rest of everything that I've been building to just fall apart.
Right.
And I think that's one of the key critical pieces for that premium protection on the insurance.
So will you say that myth one more time, or that statement one more time for me?
Yeah. So one of the myths is waiver of premium riders are a good way to protect your retirement from your disability.
Okay. So I think I want to go deep into this too, because there's a difference. So let's talk disability insurance for a minute.
Right.
There's disability insurance that you can buy that will protect your income. So if you become disabled and you own an individual disability insurance policy, you can generally protect up to about 70% of the income that you are making, and you can have the benefit pay out to you tax-free.
Right.
So for most of us, that's going to be as close as we can get to 100% income replacement. So that's a traditional disability insurance policy. Now, there's all kinds of bells and whistles you want to make sure on their own occupation definitions, the duration of the benefit, all that kind of stuff. But at a high level, that's what disability insurance is for.
Right.
Some companies also offer disability insurance that's called retirement income protection or retirement plan protection, where they will basically take the money that is being contributed to a 401k. And if you become disabled, they will continue to contribute that income for you. So that's an additional type of disability insurance that you can have that will go towards retirement.
Right.
The waiver on an insurance policy, right, can frequently be put on a term insurance policy that is then convertible to a permanent policy, and the insurance company will pay the permanent policy premiums.
Right.
So in my case, for example, I want my family to have tens of millions of dollars if I die. I want as much income to show up, as much cash to show up right away if I'm not here, so that they can make whatever choices they want to make to have the best lives possible. And I want that same protection if something happens to my spouse. The beautiful thing about the waiver of premium rider is that even if it's term insurance, right? And I'm going to do easy math. Let's say I want $10 million worth of coverage. If I have $10 million worth of coverage and I'm paying that premium on a monthly basis, I'm probably paying a couple $100 a month, right? It might be $500 a month. It might be 700. It's a big number, but for 10 million of coverage, it's pretty reasonable. Right? If I then have that turn into permanent coverage at 40-ish, $10 million worth of coverage is going to cost somewhere between $100,000 and $150,000 a year. So premium. If I have in premium, right? So if I have the ability to pay a couple $100 a month, and something happens to my ability to earn an income, and the insurance company is going to put that much money into an insurance policy for me because I can't do it myself, that is a really nice add-on, because now I know that my income is taken care of through a disability policy. My contributions to my 401k are taken care of through an RPP or an RIP program, right? And then the insurance component, which is really what's going to optimize my ability to take income and change what I can leave behind, is going to happen there. And the insurance companies don't really love this rider, right? They have it, they'll sell it to you, but they're also going to put a cap on how much insurance you can get with that rider. Some companies will only give you up to $5 million of coverage with that. Others cap it at 8. But if you had $20 million worth of coverage, and I know that sounds like a big number, you couldn't get all 20 million at the same place, because no insurance company wants that kind of risk. Yeah,
they don't want that risk profile.
Yeah, anytime a company says, I don't want that risk, it's too much, I'm going, that's when I want it. If you think there's a high likelihood that it's going to be bad for the insurance company, that probably means it could be really good for me if we're thinking about it the right way. So I think understanding what it's meant to protect for you, I think, is the key here. And I think sometimes that idea gets abused because it's phrased in a way that's kind of tricky. But if you understand what it's really doing, I don't know why you wouldn't want it. I have it on as much coverage as I can get.
Yeah. Well, and I think it goes back to that fundamental idea that the normal way to go do planning is A plus B times C, right? I'm saving this much, I'm getting this rate of return for this many years, and I'm going to be great. But inside that A plus B times C mathematical calculation ignores every single aspect of how life actually works.
I want to know my plan works when life goes wrong.
Yeah, exactly. Right. Because if I die, if I get disabled, if I lose a job, if X, Y, or Z happens, it's this idea of the high probability of low probability events.
Right.
Right. The likelihood I'm going to get hit by lightning is fairly low. The likelihood I'm going to have an airplane crash is fairly low. Right. The likelihood that any one of a series of bad things happening, but just one of those series, is actually really high. And so if I understand that I don't control all the aspects of life and that something bad could come along and take it away, then I want to build as much protection as I can into that system so that everything I want to have happen in life is going to happen within a relative degree of certainty, but I've got a better shot at making it all the way through.
Yeah, because if everything goes right and I didn't need it, I made a small mistake, right? I paid for
Right.
something that I didn't end up needing. But if something goes wrong and I do need it and I don't have it, I made a catastrophic or very large mistake.
Right.
So in a world where I'm going to make a mistake either way, I would rather make a small mistake than make a really big one that has a catastrophic impact on my family. Because the last thing that I want for my family to have to do in the event of my disability or
Right.
my death, I don't want them to have to start a GoFundMe page.
Right.
I
Right.
want to know that we adulted hardcore and we took care of our stuff.
Right. Well, that's why I love my car insurance premium every month. And I'm like, I love this because I'm hoping it is the most useless dollar
Right.
that I ever send out. But if I hit some doctor in a Maserati and he loses his or her ability to be a surgeon, like I'm crippled for the rest of my life, as well as they are, right, financially and
Right.
physically. So I want to write a small check so that I don't have to write the big check.
But you don't ever have to write the big one, right?
Yeah.
And I want to write a small check when it comes to the waiver of premium so that someone else will write that big check for me in the event I can't do it anymore.
Yeah, exactly. So let's talk about one more rider. I think in this list, we had one more rider. You should buy whole life insurance for the long-term care rider. And I'm actually going to go, I'm about 50-50 on this one. I'll be honest with you.
I think that's fair.
I'm about 50-50. I have a big, my general belief is that the all-in-one printer is not a very good printer.
It's not. I can tell you right now, mine is broken.
Yes. Mine in the house actually prints fairly well and it scans okay, but all the rest of it is just a heaping pile of crap. And so the all-in-one printer is an average scanner, an average fax machine, an average printer, right? All those things. And so I think when you start adding on these little addendums to all of the riders, and it gets sort of what I would call bloated. Sometimes it doesn't work as efficiently or as high powered as if you had
a unique tool,
right?
I think the best analogy for that is the difference between a generalist and a specialist. If
Correct.
you need a specific thing, a specialist is going to be who you want to see.
Right.
And so it's not that there aren't benefits of buying whole life that has a long-term care rider. It just may not be the reason you should buy it. There might be something else better.
Yeah, I always talk about it in the Swiss Army knife approach, right? I want to buy a Swiss Army knife and it comes with the little tweezers inside of it, but I don't buy it for the tweezers. There's lots of other ways I can get tweezers, right? And so I think the rider that comes with that is an amazing rider because if you're in a bad spot and you need it and it's there and it shows up, man, you did a good thing, right? But there's some other ways to go get that can be a little bit more efficient, a little bit more custom designed for what you need.
Well, and I'll just say this, I looked at the amount of whole life insurance that I had and the amount. So the long-term care rider on a whole life insurance policy basically allows you to spend a portion of the death benefit tax-free on long-term care. So think nursing home, in-home healthcare while you're living.
Right.
And generally you have to lose 2 of the 6 activities of daily living in order for that benefit to be payable. And then they pay it directly to whoever it's a reimbursement type policy. So you submit your bill, then they send you the check kind of thing. And the thing is, having that on your whole life insurance policy is a great safety net, but it doesn't replace the need for long-term care. So where I see that rider being beneficial is if someone does not have the ability to take care of their primary income with the assets that they have, The first
Right.
thing we have to do is optimize income strategies
Yep.
for retirement. Then once you've gotten as close to full income replacement as you can, right? Or if you're approaching it and you can manage a lifestyle, then looking at long-term care specifically, you're going to find that you can get some much more robust benefits, bigger
Right.
payouts for smaller contributions if you were looking at a specific long-term care policy.
Correct.
Where I think, though, sometimes people make a mistake is they buy a really robust long-term care policy that will take care of them if they're in a nursing home. But for the 20 years of retirement leading up to that, they don't have income. So I think there is a balance between long-term income optimization and the acquisition of long-term care insurance to protect you in the event that you need in-home healthcare or a nursing home. It shouldn't be an either-or decision unless you have extremely limited resources, and then it needs to be decided on a case-by-case basis.
Right.
But I can say, I was a big proponent of, well, I probably have enough income that I can just pay for my long-term care based on the way I've optimized my strategy. And then Eric sat me down and was like, hey, Mary, this is the policy that you need to buy for long-term care insurance. And I was like, do I really need that? And he sold me a pretty robust policy.
Yeah,
because
I'm good at spending other people's money, Mary.
Well, when I actually understood the math, it was brilliant, right? And so now I've got multiple layers of protection, but an asset-based long-term care policy that is specific to long-term care, nursing home and in-home healthcare expenses. Right. I think Mike and I put in a certain amount every year, and in 1 year of benefit, we get everything we've put in back out. And so I look at that and think that's a pretty good return on my investment. If I put $1 in and I get $1 out each year, I need nursing home care and he gets the same.
Yeah.
So there are definitely better ways to get long-term care if that is your specific purpose. But I think that rider is a nice perk to a whole life insurance policy.
It comes with it. And if it just comes with it, I'm sure going to take it.
Yeah.
So, well, let's talk about one other kind of area on this one. And this one's sort of I love this question, but you should exchange your lousy whole life policy for a new shiny one. And every time I think about that, because we've had people in the industry do this and have seen it in both ends of it. And I'm like, well, generally no. There's a couple of times where I'm like, yeah, what you have is not good. But by and large, if you've already got a good, solid whole life company with a policy with a good whole life company, don't start another one, or don't replace it and try to put something else in its place.
Right. So the reason for that is that when you roll money out of an existing whole life insurance policy into a new whole life insurance policy, you start the bulk of the cost over.
Yeah.
When a traditionally funded whole life insurance policy, the first 3 years, almost everything you're contributing is going to the cost of setting the insurance policy up.
Right.
So if you're with a mutual insurance company that has a Comdex rating of 95 or higher, I can't really ever see a time that you would want to replace that with another whole life insurance policy, because unless there's something seriously wrong with a company's financials, and generally their Comdex is going to reflect that.
Right.
You don't want to start that cost phase earlier. And if an advisor or an agent says to you, well, I can't service the policy over there, so you need to do this, that's absolutely inaccurate, because it is very easy for an agent to get appointed with another carrier so that they can service a policy. Now, there are 1 or 2 companies that will only allow a full-time employee to service their policies, as opposed to an outside advisor getting appointed and servicing the policies.
But by and large,
I can only think of 1 off the top of my head.
Yeah.
But generally speaking, even with that, the advisor should be able, working with you, to get whatever information they need in order to fix your plan. So I would say don't start the cost phase over if you're with a reputable mutual insurance company that has a Comdex of, really even 90 or higher is pretty dang good. Yeah. They're an A student at that point. So even if you're going from, oh, well, this company has a 95 and this company has a 98, still, I would say that's not a big enough differential to do something like that.
50 to 90, okay, maybe, but
yeah.
90 to 95
if you're with a company
nit.
that's not mutual and it's not paying dividends, it might be worth looking at. If your
Right.
policy is not actually a whole life policy, but is actually a different type of policy, might be worth looking at.
Yeah.
But those are really the only circumstances I can think of.
Yeah. And don't forget, it's not just the cost phase again. It's that typically you're older again. You're 5,
and your health
10.
might not be as good.
Yeah. And so there's a very thin area of where that might be a great one to go look at. And so as we work through the last kind of 2 or 3 here, one of the other ones that I always kind of find interesting is, well, I'm too old to buy whole life. I'm too old to buy permanent insurance. Once I got past 35, once I got past some random age, man, it's all downhill from here. I've missed my window. And I think that's so sad to see that conversation come through, because there's been a large number of clients that we've helped that are 60, 65, 70, 75. I mean, there's a point where they just won't sell it to you anymore. I mean, so there's some limits on that, but when it makes sense and all the math works out right, it is a viable tool at a very wide age range.
So I think sometimes the reason people say stuff like that is because it requires more cash flow as you get older in order to acquire the same policy. So even if your rating is the same, think about it like a mortgage. If I have a 30-year mortgage or a 15-year mortgage, the amount I'm going to have to pay each month goes up dramatically on a 15-year mortgage because I'm paying for a shorter period of time. Life insurance kind of works the same way. So if you're, 35 versus 65, there's an extra 30 years that you're making payments in there, and that the assets are growing for you. So of course it's going to require more cash flow to get the same amount of death benefit. What really should happen, especially once you get into your 50s and your 60s, is that you should be looking at, is this acquisition going to help increase the income I can spend at retirement? And that is dependent upon your distribution strategy. And if you were looking at a combination of a simulated pension, which we've talked about in previous episodes, or a volatility buffer, market shock absorber, whatever you want to call that, which is a different distribution strategy, there is a right amount of whole life insurance for your asset and income base. And so the math has to be done every single time to figure out if it makes sense or not. The idea that you might be in your mid 60s and suddenly it doesn't make sense is inaccurate. Now, what I have found is that once you cross that 70 threshold, depending on your health, the math gets real crunchy. It gets a lot harder. And there may be other things you can do to optimize your income strategy at that point, but I wouldn't rule it out until someone has actually done the math. And it needs to be an economics-based planning specialist who focuses on income creation. So don't just go to a traditional advisor and say, hey, should I buy this? Because they're probably going to tell you no, because they want the money in the market. But you want someone who is really a retirement income focused advisor who is looking at economics-based planning as opposed to needs-based. Because the confusion is, when you hear the word financial advisor, you assume anyone with that title does the same thing. They do not. And a lot of times financial advisors are really focused on investment management that is very different than income creation. So just make sure you're asking the right person those questions, and then that they're doing the math to show you. And if you're not sure who that person is, I'm going to give us a little plug here. We are more than happy to do the math for you, even if you take it back to a different advisor for implementation.
Absolutely. Yeah, because it's fun math, and it's neat to see the outcome just by being more efficient. So it's kind of a fun deal to do. All right, last 2. And this is one all of these I find sort of entertaining, but they're always really good fodder for conversation. So banks failed during the Great Depression, but insurance companies didn't. And thereby sort of the suggestion is you should not put your money in a bank because they failed. You should put all your money into insurance. And I love the either or and the if X happens, then Y must happen, and therefore you've got to do this thing. We had this running joke. I was a drummer in a former life, and so the running joke we had was John Bonham, who was the famous drummer for Led Zeppelin. John Bonham was a human. We are humans, therefore we are John Bonham. And so making this sort of false logic on this side. So talk a little bit about that component of sort of the banks failing, but insurance companies didn't.
Yeah. So if you were to go back in time and you look at when the banks failed during the Great Depression, what happened is people got really scared about their money. And so there was a run on the bank. Right. What that means is enough people went to the bank and said, I'd like to cash out my cash. Give it to me. I'd rather keep it in my mattress at this point. And there wasn't enough money at the banks to be able to give everyone their cash.
Yeah. The liquidity was gone.
Right. The liquidity was gone. And so when you look at a situation like that, that happens because banks are not required to keep dollar for dollar reserves. When you deposit $1 with them, they can loan that dollar out multiple times.
Right.
And there is a reserving requirement depending on the type of account. Individual savings accounts look very different, for example, than a business checking account would in terms of reserving requirements. So if you look at what happened during that time period, because of the way insurance companies are regulated, right, whole life insurance at a mutual company requires a dollar for dollar reserve, which means the capital has to be there. There's no fake money that they can loan out, right? There's no magic money in an account that doesn't really exist. And so the banks were, in some cases, bailed out by the insurance companies.
Right.
Sometimes advisors misrepresent this information and say, oh, insurance companies can't fail. The reality is that during that time period, a small percentage of insurance companies failed as well. Right. So this is part of the reason that paying attention to things like a Comdex rating is so important, because you want to make sure that you're working with an A-grade insurer, not a tiny little insurer that if they have a couple of adverse claims is going to go out of business.
Right.
And so you just really want to understand the stability of the insurance company. And I think just trusting an insurance salesperson or an advisor who says, hey, buy this, is not the way to do that. You need to do your own research. Look for a high Comdex rating, a mutual insurance company, just because mutual insurance companies are owned by their policyholders. Right. So the long-term goals of the policyholder and the insurance company are in alignment. But if you're doing those two things, you have a solid company. It's not to say, I mean, I think when people are like, don't put your money in a bank, that signals conspiracy theory. And I think that we just need to understand that insurance companies have very tight regulations, if they are mutual, for the reserving on their whole life insurance policies. And it is interesting to me that they were able to bail out the banks in that situation, but there are different regulations in place for banks today than there were back then. Yeah, so this is not an argument to abandon your bank account and put your money all into an insurance policy. That would make actual banking functions and bill pay very difficult.
Right. Well, and that's one of the things I've noticed with all of these myths as we're looking through them, is every one of the myths has a sort of thread of truth running through it. But when you look one layer deeper, there's more nuance going on than it looks like. And I kind of find most of marketing to be that way. It has just enough thread of truth that it's like, yeah, that sounds right. But then just a few feet below the surface, you're like, yeah, that doesn't quite work. All right. So this is the last one for today. So the myth doesn't understand the opportunity cost of borrowing against whole life insurance and investing elsewhere. Boy, I can't speak this morning, but the opportunity cost of borrowing against whole life and investing elsewhere. And this is a huge component of what we both kind of cut our teeth on.
Yeah. Can I say this one a little bit differently? Because I want to make sure that our audience understands what's happening here.
In the myth, yeah.
So there is a huge segment of TikTok right now that
Mhm.
is talking about a concept called becoming your own banker or infinite banking concept. Some people call it the private reserve strategy, but the infinite banking concept is probably the way most people would know a concept.
Right.
And it is
IBC.
the idea that you put money into a whole life insurance policy, and then you can borrow against the whole life policy and use the insurance company's money to go acquire whatever you want to acquire. Now, there's a lot of people that make it sound like you're using your own money. In most policies, you are not, right? If they are a
Right.
whole life insurance policy. If it is a different type of policy, that could be happening, it could not. But there are some people that have not spent time on that particular concept. And I think it's really,
Right.
really key here to understand that if you have access to short-term liquidity, right? And by that, I specifically mean checking, savings, money you can put your hands on, like same day
ATM
situation.
money.
Yeah, ATM or under your mattress or whatever it may be. It could make sense to borrow against an insurance contract to go acquire things like income producing assets, or even to buy a car if the interest rate is lower at the insurance company than it is at the like at the financing company or at the car dealership. But I
Right.
think this gets bandied about sometimes because we play a game called the car game.
Right.
And I do believe there is an episode of our podcast where we play the car game. And it may
Yeah.
even be called the car game in the episode, but it's the idea that if you leave your money compounding for you and you can use somebody else's money for cheaper, you
Right.
are essentially arbitraging interest rates and you're netting the spread.
Right.
And so this particular statement, when people are like, yeah, you're out there paying cash because you don't understand how to do this. Again, you have to do the analysis for every single acquisition that you're looking at to see if it makes sense or not. And if you have
Right.
an advisor that doesn't understand how to do that math, go find one that does, because when we use cash, what happens is we assign zero value to that money.
Right.
Whether we're buying a piece of real estate or we're buying a car, a depreciating asset versus an appreciating asset.
Right.
It doesn't matter, right, what you're buying, but how you acquire it has an impact on your finances. And if you've never seen what that impact is, you could be leaving hundreds of thousands, if not millions of dollars on the table over your lifetime.
Right.
So find a specialist who can show you, here's what it looks like if your money stays compounding, and then if you borrow at this rate, so that you can see how much you net ahead by leaving your money compounding. But in some cases, leaving it compounding, if the loan rates are too high, doesn't make sense. But again, that math has to be done on a case-by-case basis.
Yeah, and to wrap up on that, I think there's two components there that are really important. And you touched on one, this idea of EVA, or economic value add, is this idea that, and it's a fundamental thing that we talk about a lot, is giving every one of your dollars a job, and making sure that if you blow it on a pair of shoes or whatever it is you're sort of blowing it on.
See what you're doing here. I'm not.
Yeah, I just realized it was very sexist, right? If you're blowing it on something you shouldn't be blowing it on, you're not giving that dollar true value in what it could have become. Now, I'm not suggesting we never buy anything frivolous, but giving your dollar a job, right? But the other component of this that I think is sort of a natural tendency is you have what I call the left ocean people, which are all investment guys, right? All investments all the time, mutual funds, ETFs. I don't know what your problem is, but you need a better investment. There's a natural tendency to say, you know what, all you need to do is X, and whatever is they're selling is the X, right? And then the other end of the industry, which is where this myth came from a lot, is what I call the IBC crowd, the infinite banking crowd. Is the market is horrible. It's the devil, Wolves of Wall Street, organized gambling, whatever horrible story you want to put there. All you need to go do is buy insurance and 1,000 cars, and you're going to be wealthy. And
Right.
as long as you buy it the
Doesn't
right way
work
through.
like that.
Right. It doesn't actually work that way. And so one of the things that we keep pushing is the truth is really in the middle. There's tremendous value in utilizing whole life for what you can do with it, and EVA. There's tremendous value in the market and what it can go build for you. It's not either or, it's and. And understand, but I think that the natural tendency is, I've got this cool, sexy new thing. Come look at this. This is what you need to do, versus having a little bit more of a balanced approach to there's value in all these different asset classes because of how they do their jobs.
They do different things.
And it's
at
the
different times.
coordination that's the power, not the asset.
Absolutely. And we're going to be doing a series on the infinite banking concept as well,
Right.
where we break down how it actually works, how people exaggerate it, things that they say, all of that in a later series.
Right.
So keep listening, because that should come out a couple weeks after this particular episode.
Right.
And we're going to do that in part because, you know, the more that movement begins to take off on TikTok and Instagram and people are looking at it, the more we notice that there are lots of half-truths. Some of those things really work, but they're being exaggerated, or they're being taught in a way that's inaccurate,
Right.
or there's statements being made that are inaccurate. So we've had quite a few of our listeners and quite a few of our clients ask for a deep dive on the concept, how it actually works, how you
Right.
structure a policy, all of that type of thing. And so we are going to get into that in much more depth, so that there is a resource out there for people who say, I want an objective look at this. When
Right.
does it make sense? How does it work? How does it make sense?
Because it doesn't always, right? There's
Right.
lots of cases where it doesn't make sense. So,
Right. Agreed.
all righty. Where can they find you, Mary?
You can find me at The Wealth Woman, wherever you social media.
And you can find me at Economics with Eric. Gosh, I botched that.
You're gonna, you know, it's like 50-50 whether you're gonna nail that.
I feel like the Dallas
maybe.
Cowboys field goal kicker. It's like, 4 out of 5 times I'm botching this thing.
It's because we're in the playoffs, right? Every time you get to the playoffs, the Dallas Cowboys choke.
I've got the yips. I've got the yips.
Yeah.
All right. See you guys.